I suppose it's fair to say, in my sister's account, I have no career risk. She isn't going to fire me.
Ever since legendary investor Jeremy Grantham told WealthTrack how he kept his sister's money safe during the financial crisis, I have wondered, what about all the other women, many of them divorced, widowed, or lifelong singles who don't have Jeremy Grantham to call upon? Well, we've started a new feature on WealthTrack's website called WealthTrack Women. On a regular basis, investment pros who specialize in advising female clients will answer questions vital to the financial health of women. Look for it on wealthtrack.com. This week on WealthTrack, Nuveen Asset Management's widely followed market oracle Bob Dahl consults his sources of financial wisdom to conjure up a market view and build multiple mutual fund portfolios. Great investor Bob Dahl is next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Indexing and quantitative investment pioneer Dean LeBaron once said that forecasts can be injurious to your wealth. The late legendary financial historian Peter Bernstein insisted the future is unknowable, the future is unknowable, the future is unknowable several times on WealthTrack. But that doesn't mean that we won't or shouldn't try to figure out what might happen or that the exercise isn't helpful to the investment process. This week's WealthTrack guest has made a name for himself with his annual predictions and with his investment skill running several large-cap stock mutual funds for 3 decades. He is Robert Dahl, an original member of the WealthTrack Brain Trust, who is now the Chief Equity Strategist and Senior Portfolio Manager at Nuveen Asset Management. Previously, he was the Chief Equity Strategist at BlackRock and the Chief Investment Officer at Merrill Lynch Investment Managers, as well as its president. In addition to writing his widely followed weekly commentaries and annual market predictions, he has been the portfolio manager of several leading large-cap mutual funds throughout, a job he resumed last year at Nuveen. His Nuveen large-cap value, growth, and core funds have all outperformed the market and their peers in the year he has been running them. Dahl recently reviewed the status of his 10 2014 annual predictions, and here's a quick mid-year update. His forecast of 3% economic growth is still a dream, not a reality, but he is looking better on housing improving and hit it on the nail with private employment setting an all-time high. 10-year Treasury yields have not moved up towards 3.5%. They have remained under 3%. U.S. equities are having a good year so far, although we have yet to see Dahl's 10% correction. Cyclical stocks have not outperformed defensive ones. The opposite has happened. Dividends, stock buybacks, and mergers and acquisitions have definitely taken off. Corporate capital spending has not. The dollar hasn't appreciated much this year, but U.S. energy production and manufacturing are booming. Contrary to his expectation that gold would fall and commodities would languish, they have appreciated. Municipal bonds have outperformed taxable bonds by a wide margin. The jury is still out on whether active funds will outperform index funds. So far, the performance is mixed. And we will have to wait until November to gauge Dahl's prediction that the Republicans increase their lead in the House but fall short of capturing the Senate. I began the interview by asking him which of his current market predictions matter most to investors.
Given I'm an equity guy, Consuelo, I start with the one, stocks have a good year. I think that's the one that's most important. And year to date, so far, so good. In fact, stocks have probably done better than most people thought on January 1st.
Better than you thought?
Definitely better than I thought. I thought we'd have, like many, a good year, but not a great year. If you annualize the first half, it'll be a really good year. I'm not sure it's safe to do that, but nevertheless, it's been quite good.
You also predicted a 10% correction just because we need a correction?
Just because we wanted to tell people life's got to become more volatile at some point. And the main reason for that is the Fed and liquidity. The Fed's been throwing money at the system for how many years now? And part of what that does is reduce the volatility. As the Fed withdraws liquidity through the tapering process and eventually through raising interest rates, that means there's less liquidity, and I think that will lead to slightly more volatility.
So that is the big thing that investors are scared of. They are petrified. Volatility to them equals risk.
And I can't fight that. Volatility does equal risk, but what I will add is risk has two sides to it. So often we find people say volatility, risk, all downside. No, 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 no. Stocks can be volatile to the upside as well, and that's the nice side of things.
So looking at how the market is done in the first half, what are your predictions for the second half? Is it going to end up to be a really good year or just a good year?
I'm guessing, Consuelo, that the economy is in the process of doing better in the second half than the first half, which ironically probably means the stock market does okay, but less well in the second half than the first half. We basically had 1% per month in the first half.
The stock market appreciation.
Correct. And if I can get 0.5% a month on average for the back half of the year, it will still have been a very good year. My point, I think stocks will end the year higher than where we are today, but I think the second half is going to be tougher than the first half. Bumpier and probably not as strong.
Bob, why do you think the economy is going to become stronger when it has never failed to disappoint throughout most of this recovery?
It has been a very tough recovery. We remember the bursting of a huge credit bubble in 2008 and 9, bigger than anything any of us have ever, or I pray ever will see. And the aftermath of that is a long period of paying down debt and deleveraging, which is a dampener on growth. But if you look at where things are today, let's start with the consumer. Consumers are doing a bit better. More of them are working. Employment in this country is at an all-time high.
Private employment.
Now total employment has gotten there as well. And real wages, they haven't moved up much, but if you look at past business cycles, it's usually the second half of the cycle that wages begin to pick up. I think we're at the cusp of that as well. The corporate sector continue to buy back stock, continue to raise dividends, but now they're buying the company down the street, and what is left is capital expenditures, and I think that one's right around the corner too. Even the government is beginning to help growth. Remember the austerity through the sequestration process last year? That's much smaller this year, which is almost 50 basis points or 0.5% help to growth. So all those things come together, make a good but not a great economy.
There is a theory out there that the U.S. economy is decoupling from the rest of the world. We started the recovery sooner. We have an energy renaissance. We have a manufacturing renaissance going on in this country. Yet we also talk about how interconnected we are globally. Isn't there a risk that the rest of the world, Europe, Japan, which are all in a slow mode, China, for instance, is slowing, isn't there a risk that they could, in fact, drag us down and slow our growth and our progress? So
through net exports, the answer to that question is yes. But net exports as a percentage of our economy is a lot smaller than many others. We're a big, huge domestic economy. Forget the rest of the world for the moment. But then the rest of the world is doing a little bit better. China is slowing. So let's take China. China is the biggest user of commodities. The U.S. is the biggest user per capita of commodities. So if China slows and commodity prices come down as a result, guess what? That's good news for the U.S. So some of these things have positive offsets as well. It's not just necessarily a negative.
The macro picture, you come up with these 10 predictions every year. How much does the macro picture and understanding what's going on in the big picture really matter to investment success?
I think in the long run it matters primarily from asset allocation. I'm a stock picker, I manage money. That's what I spend the vast majority of my time doing, and it is largely out of the research we do for those portfolios, bottom up, that the macro top-down thoughts and predictions come. So it's not as if I wake up in the morning and say, you know what, I think technology stocks are going to win. It's that we've talked to technology company A, B, and C, and the prospects look good, and all of a sudden we say, I guess we better like technology as a result. So much of the macro thinking comes from detailed bottom-up work.
So you are applying your micro work on the company level to come up with the big picture.
Exactly right. In my view and over my career, I think that's been a more successful strategy. I think it's risky to make the macro bets without the micro follow-up or the undergirding, if you will. And I've done it for so long, I've relied on this more and more over time. I think it just has higher probability of accuracy and success.
As you look at the micro work you're doing, the company research that you're doing, what are the companies telling you?
Things are getting better. There's no question about it. Things are getting better.
And things are getting better in the U.S. specifically?
Yes, in the U.S. specifically. And I would say many companies are still, however, cautious. Maybe they can see 2 feet down the road, whereas a year ago they couldn't see at all. It was total fog. Maybe a year from now they'll see 6 feet down the road. So it's a process. I come back to what we talked about earlier. This credit bubble bursting and all the tentativeness that's come from it. The application to the stock market is, this is the least believed bull market of my career. People are still concerned about if I buy something, it might go down, as opposed to if I don't get invested, I may miss something good.
Where is your belief level in looking back at your career in this bull market?
So I think that bull markets climb walls of worry, the old cliche, and there are all kinds of walls of worry in this environment in which we find ourselves. Let me say it a different way. Bull markets don't end when people are cautious. Bull markets end when people throw caution to the wind and think this is the greatest thing since sliced bread. I just don't hear a lot of that thinking, whether it be individuals on the street or financial advisors and the like.
Therefore, your belief in this bull market 5 years in, where are we?
So let's put the sober hat on for a moment. We are 5 years in and the stock market's almost tripled. My view is, from an economic cycle perspective, we're probably at least halfway. And from a stock market's perspective, Consuelo, we're much past halfway. Stocks aren't likely to triple again before we have another bear market. So I hate to say it, but the easy money in the stock market is in the rear view mirror. Doesn't mean going forward there isn't money to be made. I just think we need to be more careful, more of a stock picker's market. There's going to be a bit more volatility and the rate of gain is going to slow. But my choices, if I'm in financial assets, are stocks, bonds, and cash. Cash is returning zero for the foreseeable future. If the economy improves, in my view, when the economy improves or as the economy improves, interest rates will trickle higher. That's not great news for bonds. So I can come offensively and defensively into, I want to own common stocks.
I keep hearing that it's relative to, that stocks are attractive relative to, but in absolute terms, are stocks attractive?
I think they are. So in 2013, it was all about valuation or PE improvement. I can't pound the table and say we're going to get much more out of that. So it's got to come from E, or earnings. In my view, if we look out over the next, let's call it 5 to 10 years, I think we can get 5 to 7% earnings growth, which is way below the long-term average. I add 2% for the current dividend on the stock market, so 5 to 7 becomes 7 to 9. Let's just call it mid to high single digits. It's not a great return over the long term, given what we've been through, at least most recently, but still very respectable.
Nuveen, the firm you are with now, is known for its municipal bond expertise.
Yes.
And one of your predictions is that munis will outperform corporate bonds this year. They have done by a wide margin so far this year. Why the faith in municipal bonds?
Well, first of all, a thank you to Detroit and Puerto Rico for having problems. Without those problems, we wouldn't have had a widening of spreads and a cheapening of munis versus other fixed income instruments. So that's the first thing, setup, valuation. Secondly, the fundamentals are changing. Take Detroit. The bankruptcy judge said pensions are not going to be fully paid. That's a big change to the unions. And thirdly, municipalities are actually mostly in very good shape. Most of them are running surpluses.
Now, as opposed to a couple of years ago.
Correct. And as a result, they don't need new paper. Munis are a fairly thin market, and so supply and demand really matters.
How worried are you about bonds?
So worried, I think interest rates will drift higher, which means that's a headwind for all bonds. Gallop higher, I don't think we have a strong enough economy for interest rates to gallop higher, but if I think rates are going up, how can I not be worried about bonds? So I want less of them in my portfolio than I might over a long-term period.
Less of them, not out entirely.
Not zero. It's a huge asset class. And look, let's take the first 6 months of the year. Many of us, I'll put myself in that category, thought interest rates would fall, and they have, would rise, excuse me, and they have gone the other direction.
Yes.
As a result of economic weakness, continued low inflation, a bunch of other things. So just like bull markets don't go straight up, bear markets don't go straight down, and we've been in that period for bonds, but I think the risk reward is not very attractive.
Back to your area of expertise, which is stocks, and specifically large cap US-based stocks,
Yes.
which you've been managing portfolios of for some 3 decades.
Yes, ma'am.
What do you look for in a company to put in one of your portfolios?
All kinds of things. You know, what are we emphasizing now? Cash flow.
Why?
We're in a slow growth world, despite our belief the economy is going to get a bit better. If a company has positive free cash flow, Consuelo, there's a chance they can grow. Without it, there's one hand tied behind their back. So free cash flow, preferably the acceleration of it, is the starting and sometimes the ending point for our stock selection.
Give me some examples of companies that exemplify the kinds of companies that you are putting in each of those 3 portfolios.
Let's take one that we have in all 3 portfolios that everybody knows, and that's Apple Computer.
Thank you, because I was going to ask you about Apple.
There we go. So Apple Computer, let's start by, I think it falls between the cracks despite its size. The growth investor says, is this still a growth company? And the value investor says, is this cheap enough for me to call value? And I think therein lies the opportunity. Lots of cash, lots of free cash flow. Question is, how are they using it? That's a different answer today than it might have been a year ago. They've raised their dividend, they're buying back stock, and look how well the stock has performed. So there's a good example where free cash flow has made a difference and the intelligent use of that.
And your view of its valuation?
So it's not as cheap as it was, that's definitional, but I think that, look, they have some wonderful markets, many of which are still growing, and I like to say they have a swing at the plate for a new product or a new application almost once a month. Sometimes it's a marginal ad, you hardly notice the difference. Occasionally it's somewhat bigger. In the old days, and maybe sometime in the future, they'll have a grand slam home run. Let's hope that's the case. But the stock is not incorporating any of that in its current valuation.
Tim Cook versus Steve Jobs?
Very different people. I think Tim has found his stride. You know, it's hard to follow in Steve Jobs' footsteps.
Yes.
Let's face the facts. And it took him a little while, but he's got his sea legs, and I think he's doing a marvelous job.
Another company, for instance, that's in value, that exemplifies what you look for in a value stock.
Macy's.
Macy's?
Macy's.
A retailer.
A
New
retailer.
York.
And distinguish it from JCPenney. JCPenney's had a lot of problems, and Macy's, among others, has been the beneficiary. Macy's has good merchandising strategies. They have good buying strategies. They've been at the cost-cutting and efficiency process and continue to find new things, and that's why the stock is a pretty good performer.
What makes them a value choice?
The fact that the PE, price-earnings ratio, is fairly inexpensive, that the company continues to move up as the earnings move up, as opposed to being a big PE multiple on the hope and the dream of something that might come. It's the here and the now.
Let's talk about the hope and the dream in the growth portfolio.
Yes.
What's a company that you think epitomizes your growth approach?
I almost always use growth at a price. And for me, Medtronic in the healthcare equipment area would be an example. A company based in the Midwest that continues to develop new strategies and new machinery in order to solve the increasing number of healthcare problems, and they're growing and managing their business very well. And I have to bring it up again, cash flow is part of the story.
I looked at your portfolios and I saw that Verizon and Oracle are both in large cap growth and large cap core shares. Verizon and Oracle.
Yes,
two very different
companies. Both in the Russell 1000 growth and value indices. That's where we have to start to be eligible. Oracle certainly has a higher growth profile than Verizon, but some would say Oracle is not the growth company it used to be, and that's probably accurate. They've done a pretty good job of acquiring companies to keep their growth rate at a reasonable pace. Verizon, it's a cheap stock in a challenging industry, but it continues to raise its dividend.
So you are a large cap guy, But individuals are being told to diversify their portfolios and to diversify among, mid-cap, small-cap, foreign holdings, alternative investments, REITs and timber and commodities and everything else. What's your view, number one, of the age-old advice to diversify among many asset classes? Start with that.
I think we have to do it. Why? No matter how much I might pound the table on my favorite asset class, U.S. equities, I don't have a crystal ball and perfect ideas, and therefore you need to have something that mitigates the risk of putting all your eggs in one basket, and that's called diversification. So I'm 100% for it.
Where do large cap stocks fit in one's portfolio diversification?
Well, a U.S. citizen should look at the U.S. equity market, to me, as the core of their portfolio, along with global equity markets. And so U.S. large cap is a huge play there. The U.S. stock market, in my view, is not really a U.S. stock market. It's really a global stock market. The S&P 500 gets almost half of its revenues and more than half of its revenue growth from outside the U.S. They happen to be domiciled in the United States, but they're global companies.
Therefore, can you be globally diversified by owning large cap stocks, for instance?
Absolutely. And one of the things we manage in our portfolio is how much of the earnings in the portfolio come from the U.S. and how much from outside the U.S., even though all the companies we own are here in the United States. So certainly you can do that. And that doesn't mean I'm suggesting don't own anything outside the U.S. Certainly there are great companies. Europe has some wonderful multinationals. Japan's has some good ones as well.
Biggest mistake investors can make in the market right now?
Panicking at the wrong time. Either direction. We all know highs are made when everybody barrels in thinking this is my last chance. And lows are made when people think this is the end and the world's going to fall apart. Rarely does it fall apart, and rarely do trees grow to the sky. So I think at extremes, the danger is letting your emotions get control of you. I know as a portfolio manager, and I've learned this over time, and I still haven't perfected it, even though I've been doing it more than 30 years, is to be objective. What's the reason you bought the stock? Is that coming through? Why are you in stocks? Why are you in bonds? Don't let the price action of yesterday so dominate your thought process about tomorrow.
Being objective about the market now, we don't seem to be at an extreme. And many investors are not pretty committed, are not committed to stocks at all. As a matter of fact, the money flows into stocks have been quite meager compared to what they have been in bonds, for instance. Could one of the biggest mistakes that investors are making now is not being more involved in stocks?
Generally, that's the case in my view. A lot of people have missed this bull market. They're still waiting for the proverbial pullback to put money in. And my view is don't try to pick tops and bottoms. Figure out what your portfolio should look like. And if you need to put some of your money in stocks to get there, go for it. Not all tomorrow morning. Put a little bit in tomorrow, a month from now, a little bit more. The old dollar cost averaging, it works.
What about taking some profits now after a 5-year bull market?
If you've been in stocks and you've made a lot of money, no one ever loses by ringing the cash register. I have no problem with that at all. Buy stocks that are cheap with good free cash flow and let some stocks go that have run hard and or their fundamentals aren't there. Stocks have almost tripled. There are some things that should be sold.
One investment for a long-term diversified portfolio, what would you have us own some of?
I come back to this free cash flow concept and the ability, therefore, to grow dividends. Free cash flow is a hard concept for a lot of people to get their hands around, but one manifestation of it is dividend growth. I'm going to distinguish dividend growth from dividends. When bond market was doing well, both dividends and dividend growth did well. Now we're separating one from the other. Be wary of companies that pay dividends and can't raise their dividends in this environment, but companies with dividend growth. That's my theme.
And is there a way to play that you would recommend that
I think that the best way to do it for individuals is to look for a mutual fund that has those sort of characteristics and or own the companies outright.
Bob Dahl, it is such a treat to have you from Nuveen Asset Management.
Thank you, Consuelo.
Thanks for being here. At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is a bit more cautious towards the market than Bob Dahl is. He might be correct in his expectation that the market will continue to climb its wall of worry for the next couple of years, and his job is to stay pretty much fully invested. But we don't have to do that as individual investors. So this week's action point is take some profits in your top performers of the last 5 years. Whichever mutual funds, index funds, or stocks have given you the biggest gains and perhaps have achieved an outsized position in your portfolio, sell some, let's say 10%. Either reinvest the proceeds in lagging sectors or funds that you believe in, or put it in cash to hold until that inevitable correction comes. Next week, we will talk exclusively to a great global investor, Bill Wilby, and veteran international economist and strategist, Nick Sargent, about the rising investment risks they see around the world and how they are handling them. To see this program again and revisit other great investors and financial thought leaders, go to our website, wealthtrack.com, and please visit the latest installment of our web series, Wealth Track Women, where we will have updated financial advice specifically for women from our panel of women financial advisors. Our current focus is what to do when financial plans go off course. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation.